So, today, let's try to step into the mind of an absolute legend, Warren Buffett. We're going to take his timeless four-step test for picking stocks and apply it to a really modern, kind of complex tech company. Can a philosophy from the 20th century still find value in today's market? Well, let's find out.
I mean, that's the billion-dollar question, isn't it? And the answer has nothing to do with fancy stock charts or complicated algorithms. For Buffett, it's all about a simple, but really profound, set of principles. They're designed to separate the truly great businesses from the merely good ones, or, the bad ones. And we're going to unpack that exact framework.
Okay, to make this real, we need a test subject. And what's better than a company that's right in the middle of the modern economy? Let's take Micron Technology. They make the memory chips that power pretty much everything, from our phones to massive data centers. It's complex, it's super cyclical, and honestly, it is the perfect company to run through the Buffett gauntlet.
And here's our roadmap. 4 simple-sounding ideas that really build on each other. We're going to start with the business itself, then we'll look at who's running the show, check if the numbers actually back up the story, and only then, and I mean only at the very end, do we even start to ask about the price.
So, first up, the business. Buffett famously uses this analogy of a castle in a moat. Is the business this impenetrable economic fortress, or is it kind of vulnerable to attack? Let's find out. So what is this moat he's always talking about? It's really just the company's durable competitive advantage. Think of a brand that's just so powerful, or a secret formula, or maybe a massive cost advantage. It's whatever that thing is that keeps competitors away and lets the company earn really high profits year after year after year.
Now, this is where it gets really interesting when you look at how Micron stacks up. I mean, sure, we can understand what they do. They make memory chips. But is the business consistent? Oh, absolutely not. The whole industry goes through these brutal boom and bust cycles. And the really crucial point is right there at the bottom, pricing power. Micron has almost none. They are a price taker, not a price maker, because what they sell is basically a commodity. And for a Buffett-style investor, that is a huge red flag.
And this slide just perfectly illustrates the difference. A wide moat company like Coca-Cola has a brand that lets it charge a little bit more, it's insulated. Micron, on the other hand, sells a commodity product and is stuck in this constant, incredibly expensive arms race with a few other giants to build the next best factory. Their moat is really narrow. It's based pretty much only on their massive scale.
All right, let's move on to tenet 2, and you'll see how this builds. Even a decent business can be totally ruined by bad decisions. So Buffett looks really closely at the people in charge. Are they honest? And maybe more importantly, are they rational when it comes to spending the company's money? So this is what Buffett is looking for. First, you need integrity, but just as important is rational capital allocation. And that means avoiding what he calls the institutional imperative. That's the tendency for CEOs to just mindlessly copy what their peers are doing, like spending billions on new factories at the very top of a cycle just because everyone else is. For a company like Micron, a rational manager would fight that urge and instead buy back stock like crazy when the price is low during a downturn. It sounds simple, but it is incredibly rare.
Okay, so we've got a story about the business and its management. Now for tenet 3. We look at the financials to see if the numbers actually confirm that story, because, talk is cheap, but the numbers, they don't lie.
And wow, do these numbers tell a story. This is not a gentle wave, it is a roller coaster. You can just see Micron's profit margin swinging wildly from over 50% at the peak of a cycle, all the way down to being negative at the bottom. This visual perfectly captures that brutal inconsistency we talked about. It's the exact opposite of the steady, predictable financial performance that Buffett loves to see.
So while pretty much any company can look good at its peak, Buffett does a full financial health check. He's looking for things like a consistently high return on equity. That's basically how much profit the company makes for every dollar of shareholder investment, and ideally he wants it over 15%, and strong free cash flow throughout the entire cycle. Because of that roller coaster we just saw, Micron's numbers just fail this test. Its profitability isn't stable, which makes it pretty much impossible to predict its long-term earnings power.
And now we've arrived at the final tenet. This is the one everyone thinks of first, but Buffett insists it has to come last. The price. After all of this analysis, is the company actually on sale for less than it's truly worth?
This right here is the absolute cornerstone of value investing, the margin of safety. It's actually a really simple idea. You figure out what a business is worth, and then you only buy it if you can get it at a big discount. That's your protection. That's the safety net that catches you if you've made a mistake in your analysis or if the world just throws you a curveball. But how in the world do you value a company like Micron? You can't just use last year's massive profits.
because that was a peak, and you definitely can't use a trough year's losses. The only way to even try is to figure out its normalized earnings, what it can earn on average across an entire boom and bust cycle. And let me tell you, this is much more of an art than a science. And because of all that uncertainty, and because the business has such a narrow moat, the margin of safety you need has to be huge. An investor using this framework wouldn't even think about it without at least a 20% discount to their conservative estimate of its value, and probably a lot more. You have to demand a lower price to make up for the higher business risk.
So we have run the gauntlet. We've looked at the business, the management, the financials, and the price. Let's put it all together and finally answer our original question.
Buffett's own words frame our conclusion just perfectly. See, early in his career, he looked for what his mentor called cigar butts, fair or even poor companies that were selling at a wonderful price. But he later learned it's way better to buy a wonderful company at a fair price. So which category does Micron fall into?
Here it is, the final scorecard. The business, it lacks a wide moat and has zero pricing power. Management is stuck navigating a really tough cyclical industry. The financials are the very definition of volatile. And because of all of that, the price would need to be incredibly cheap to even be considered. It just fails the test on the first three tenets.
And this brings us to a really important distinction. Micron is not a wonderful company that Buffett wants to buy and hold forever. But it might be what his mentor Ben Graham called a cigar butt. You know, a poor business that's so cheap you can just pick it up off the street and get one last free puff out of it. It's a completely different investment philosophy, one that's focused on getting a deep discount, not on business quality.
So yeah, Micron clearly doesn't fit the modern Buffett mold. But the real takeaway here isn't about one single company. It's about the framework itself. The next time you're looking at a business, just forget the stock price for a minute. Start with the castle and the moat. Ask yourself, what's a wonderful company that you truly understand? Because applying this test, that's the real secret to thinking like Buffett.